Welcome to the Trader's Desk. It's the 3rd of August 2025. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer and do read the copyright notice as well. So we had quite an interesting week in financial markets. Um, a bit of a sell-off on Friday, but really the market reached its peak mid of the week, and then we had the big purge on Friday after the NFP jobs report. So there's a lot going on in financial markets. So the question is, have we reached a turning point? Is this just a correction, or are we going to see this bull market getting dismantled, right? Um, no one really knows. It's a bit early also to tell, but the one thing that we have to pay attention to is the reversal was quite a big one, quite a violent one. And from here onwards, I think we need to make sure that our portfolios are taking into consideration the changes that we are seeing in financial markets. So, as we've discussed, volatility has been on the rise, and we are quickly moving from a portfolio manager's type of market to a trader's type of market, right? So, moves, what does that mean? Moves will happen a lot quicker, right? Uh, let's say you had a company trading at $100 and you thought it would take a long time to get to 90. By Friday, we could be at 90 if volatility increases. That's the kind of changes that you'll see in the financial markets. Both the S&P 500 and the Nasdaq sold off quite a bit. This was quite interesting to see. Of course, there's a lot happening with the macro. So the NFP data in itself disappointed on Friday, but then what was the most remarkable was the significant downgrade of previous 2 months of NFP payroll data. If you take off the last 3 months together, there was barely any significant jobs created. And also, if you become a bit more discerning and if you isolate the jobs created by healthcare sector, you would realize that we probably have been negative in terms of job creation, which does not bode well for the economy as a whole, right? So, of course, we know that consumer discretionary spending uh, will be quite significantly linked to the jobs data. Um, it's not just people losing jobs, but it will also be in the sentiment that it creates in people's mind, right? So let's say you just realize that your neighbors have lost their jobs, right? It's going to trigger something in you to make you a bit more defensive in the way you're spending, the way you're looking at future purchases, and so on. So, as we've seen, we've had a very resilient consumer spending environment so far, and the question now is, as we see employment markets getting weaker, do we see a drop in consumer sentiment or a further drop in consumer sentiment? As we've seen in the reports, there's been a bit of a recovery in the consumer sentiment, but it's still at a low level. The question is, are we going to see a retest of the lows? But more importantly, it's everything to do with what is the Fed going to do next, right? So the Fed has been pushing this whole theme of being data centric and only reacting when the data is showing something conclusive. So the Fed has two mandates. One is to maintain inflation at its target of 2%, and the other is to make sure that the employment or jobs market stays strong, right, and supportive of economic growth. So the Fed is already failing on its inflation target. As we've seen this week, the core PCE numbers ticked up, right? So the Fed has one problem to deal with. And then going into the this week's meeting, the Fed they did not have the data for NFP on Friday, right? So they were looking at the NFP reports from previous months and making the assumption that the jobs market, although it's been slowing down, they came to the conclusion that the economy is still strong and the job market is still healthy. So how much would that one extra report now actually sway the expectations? Uh, I think Powell would be quite what's the word? Quite worried or quite even angry, right? Seeing these numbers. But if you think about it, I've discussed it in the Discord server. When we have inflections in the economy at these different periods when things are changing quite significantly, the variability of the jobs numbers can be quite significant because of the way they get measured with surveys and all of that. It's quite normal. We've seen these types of wild fluctuations, especially when the economy is at a turning point, both on the up and on the down, right? If you are keen to look at this, you can always go back to previous cycles, look at the pre-COVID, post-COVID phases and see the revisions and so on. But what what is important to us here is what do we think the what do we think that the Fed will do next, right? So the markets have moved towards a you know basically like a big consensus that the Fed will cut on in the next meeting in September, which is somewhere in 6 weeks. Um, and it's almost like a certainty now, right? So the market has been having these like certain illusions for many, many months, right? And been wrong every single time, right? Going into August, somewhere in June, it was almost certain that, the Fed would cut according to the markets. And then a few weeks before the meeting, everyone went to probability of 0 to 20%. So um, it's not really important what the market thinks or what probability it's assigning to a cut. That does not necessarily mean that the Fed will cut, right? I think the Fed has been quite transparent in telling you what they look at in terms of how they make decisions. And what we need to keep paying attention to is the next job market data and also the PCE CPI numbers. So I think the Fed will be faced with its ultimate nightmare. What do you save? Do you save the country from hyperinflation, or do you save the country from a poor jobs market, right? Or layoffs? The other question is, if you cut rates, and if a lot of these layoffs are happening because of AI being implemented, cutting rates, would that mean bringing these people back into employment? I highly doubt it, right? So past cycles have shown that when you cut rates, then the economy gets stimulated after a few months, right? And then the jobs market picks back up. But what if, AI is causing massive replacement of labor? Cutting rates will not necessarily cause the same kind of recovery that we've seen in previous cycles. But anyway, it's too far out to have these discussions at this point in time. What matters is how markets are reacting to it and what can we do from that perspective. So let's move on. If we look at the RSP, which is the equal weighted version of the S&P 500, quite a big move, right? So it seems like we've hit this resistance level and then we've just gone back down quite aggressively. So this whole theme of the market broadening, again, that just gets rejected. And I think from my perspective, to see the bull market carry on, we definitely need to see a broadening out of the rally. So small caps, mid caps also need to participate. Uh, the economy cannot only be within the top 7, 10 companies, right? Um, Quite notably, we've had a big sell-off in the Magnificent Seven. So this is telling you that institutions are de-risking, right? That's predominantly because of VIX. Also, the Magnificent Seven have had a phenomenal move from the lows of April, right? So it would make sense to take some profits here. And I think it's only the start of the sell-off in the Magnificent Seven. I don't think that this will recover this easily from here. But we can only bear witness to what will happen next. But from my perspective, the Magnificent Seven turning is a big signal in terms of what the market is doing under the hood, right? So if you're selling Microsoft, Google, Tesla, Apple as part of your portfolio, surely you're not buying like the crap that is nearly close to bankruptcy, right? So think about that. If you're taking profits on all these massive, like extremely well run, best of companies in the world, the next move is not going to be taking your money and then buying something like, uh, like a recreational vehicle producer or like an auto dealership, right? That's not the next thing that you're buying. You're probably buying treasury, you're probably, moving across asset classes, maybe even moving out of the US, right? There's one graph I don't have here, but we can always draw it quickly. So this is the S&P in euro terms, right? This is quite telling. We thought that we were having a breakout here, and then in the space of 2 days, it just went back to below the 200-day moving average. So could we be seeing an exodus of capital from the US? Quite possible. Um, you know, Getting the answer to that question does not necessarily make us a lot of money. It gives us perspective in terms of what might be happening. But at the end of the day, we have to understand that this is a relatively strong risk off move, right? And in a risk off move, you're not going to be playing, let's say, your silly, dirty, short squeeze move, right? Now is not the time to go play this. Does that make sense?
Yes, for sure.
Okay, super. Um, the next shot is going to make you laugh. So not this one, but the one on the right. So let's actually move to that right away. So the momentum stocks, right? The ones that have been driving the market higher, the ones where retail have, just like sitting and they've built hotels around these stocks, right? So they are basically like lazy longs and sitting in over leveraged positions, either in options or in, shares that they've bought with leverage. So that momentum ETF was down only, I think, 1%, while Nasdaq was down 2% something on Friday. If you ask me, I would rather believe the price action here versus the price action in this particular ETF, right? What does that mean? I think we could see a big move down here. I don't think we've seen the worst in terms of the sell-off yet. Uh, to me, it seems that retail hasn't gotten the memo yet. Okay. And I'm quite willing to bet on that because I don't think that a lot of these moves that happen, within the stocks that are in these ETFs, a lot of them are not based on solid fundamentals. A lot of these are just momentum driven plays where the underlying factor is FOMO, right? And as we know, this never ends well because if you buy a stock that doesn't have a backbone, it will just fall over itself, right? That's the way to think about it. Going back to the chart on the left, the IWM, so basically the small caps, the Russell 2000 ETF, a big break below the 200-day moving average. So again, that does not bode well for the risk on sentiment, right? I think we're going to struggle a little bit here, and we might even move a bit lower before we see any recovery in these stocks. And this is great for us, guys. I think I'll discuss it in the second part of the presentation because that's a bit of a tactical thing that can make us quite a lot of money, right? Um, yeah, nothing to discuss within the YouTube version of the video. Moving back to the US 10-year yield. So this is something we've been watching quite intently, the long-term yields. Quite a big move on Friday, especially when we take into consideration that the Fed might be cutting, but also when we take into consideration that there might be a bit of a growth scare or growth slowdown in the US economy. However, I would have thought that if there is concern that the Fed will start cutting and start cutting aggressively, these long-term yields would have moved a lot more, right? I mean, on the chart, it looks like a big move, but it's only moved from 4.33 maybe to 4.21. So something like a 12 to 15 basis points, which is nothing, right? Um, and this kind of fuels my suspicion that we might have a situation where the Fed cuts.
We lost your audio, Roshan.
Oh, sorry about that.
Oh, it's coming. It's coming back now. It's coming back now.
Okay, not sure what happened, but anyway. So what I'm saying is this fuels my suspicion that we might have the Fed cutting, but the long-term yields stay high. On the left, what I've got is the basically the yield curve for the US at three different points in time. So the blue line is the current yield curve. The red line is the yield curve 1 month ago. And then the purple line is the yield curve 1 year ago, right? So there are two things I want to point out here. One is if you look at the 10-year horizon, right, the 10-year yield, there's not been a big move from from where we are now compared to 1 month ago, right? It doesn't look like a big move, right? Um, And that's again talking to the point I was making when we were looking at this chart over here. If we look at a bit, longer term yields, so closer to 15 to 20 year, if we compare the long-term yields currently versus what the market was pricing 1 year ago, we've got quite a significantly higher long-term yield expectation from the yield curve currently. So what does this mean, right? Why are we quite significantly higher? I mean, the gap here is massive, right? We're talking, uh, let's look at the 20-year, right? We're talking probably 4.1 versus 4.5. That's a massive gap. Because we're talking of 20, like a 20-year yield, right? A 0.4% gap is quite big. So what what changed between now and 1 year ago? It's basically the long-term expectations of inflation. And you can see this, it's quite obvious, right? The market is expecting a higher level of long-term inflation, much higher than it was expecting a year ago, when inflation itself was much higher. If you recall, right, a year ago we were struggling with inflation, and the current yield curve is pricing in a higher estimate for long-term inflation. So this whole, story around bond investors being quite concerned about what the Fed is doing and in terms of not being able to reach the inflation target, firstly, and secondly, also all the deficit spending that's happening on the fiscal front by the US government. So these two, you can clearly see this in this graph. Is that making sense, guys? Is that making sense? Anyone?
Yes.
So why do we care so much about these long-term yields, right? Because the long-term yields are basically like a handbrake for long duration assets. For sectors which are highly interest rate sensitive, like housing, um, this is like a big slap in the face, right? And of course, the opposite is also true, right? If these rates come down, it's highly stimulative for these sectors. So the market, right, on Friday, we were all looking at home builders pulling in quite a nice performance on the day. Um, but when you look at what the bond market is telling you, uh, it's complete opposite of what the equity investors are thinking, right? And in these cases, the bond market tends to be right because the bond market spends, 99% of their time just figuring out what inflation is going to do in the future because they live and die by that estimate. Whereas equity investors are looking at other things, right? They're not necessarily that concerned about inflation in the future. So these are two very different asset classes, very different investors who are looking at things very differently. Um, Bond market investors are mostly worried about capital protection. Basically, they are looking to earn a yield on their capital and to make sure that they don't lose the capital, right? So the capital is not at risk. Whereas equity investors are mostly seeking to get capital gains. So they don't mind risking capital to make a profit, right? So the bond market investors are, they will give you 100 with the promise of having $5 every year for the next 10 years. Whereas equity investors will give you $100 with the expectation of selling that asset at 150 in 6 months' time. So these are very, very different investors, very different ways of, finding opportunity and pricing risk. And it's important for us to understand the distinction between these two asset classes. So uh, equity investors would tend to do relatively well with inflation, whereas bond investors would basically be stifled to death if inflation runs above target. Because, uh, that $5 is fixed, right? Uh, and 10 years later, the $5 might be worth nothing, right? If inflation has eaten all the gains, right? Like the $5 might be worth 50 cents. And then as a bond investor, you're basically, the subject of a big joke, right? Which is basically what's been happening for the longest of time to bond investors. And that's why you see that now they're becoming a lot more concerned about long-term inflation expectations and so on. Um, this is the short squeeze monitor, right? So it's been a relatively good week, right, for the short squeeze plays. All of them, except from three on the list here, have sold off significantly. Who remembers APLD? We discussed it last week. APLD on Thursday was up 35%, and then it ended the week up 16%. So if you had played it, you'd be laughing to the bank, right? And when did we discuss this? Last week, right? So that's why I say whatever we discuss in these presentations are actionable. If you just spend a couple of hours, I mean, it could even be 1 hour, and then you realize there is asymmetry to be played here, and you play it with options. Um, the kind of returns you'd get would just be ridiculous. And that's while everyone is losing money in, within retail, within institutions. The market is heading down, but you're the guy who's basically just sitting there smiling. Um, anyway, so like I mentioned earlier, I don't think this is the time to be playing short squeezers because the market is going into risk off mode, and there will be a time for this to work. If you're still keen about this, you can start do your work and find a couple of names that you're probably going to play when the recovery is underway. But that's not going to be next week, right? So don't be excited and say, hey, look, we discussed APLD last week, that worked. So I'm just going to pick a guy from this list and it's going to work next week. You have to understand that the market mood has changed, and this is not the time to be playing these plays, unless you have specific cases where you know you've got catalyst and you can see how the short squeeze can still play out. I'd probably refrain from putting a new position this week, right? Moving to sector performances. So it's been a big risk off move. So the S&P itself was down 2.4% on the week, uh, after being up quite significantly for in the last few months, right? So if we look at the outperformers, the utilities did relatively well. So we've seen a big risk-off move, right? Materials were the worst performers, a large part because of, the growth slowdown being priced in. Also, some companies announcing earnings that were not that good. So the market is starting to price in a lot of these earnings. Um, Consumer discretionary also like quite a big sell-off. So if you look at the sectors here, we've got consumer staples in the outperformers, consumer discretionary in the underperformers. So a clear distinction between risk on and risk off, right? So we are clearly moving in a risk off environment. Does this make sense, guys? Okay. In terms of industry performance, so the only industry that was up on the week was MLPs. I'm not going to discuss this here, but if you're interested, you can Google and figure out what the hell these are. It's linked to oil markets and they are kind of royalty type assets. Um, and people like the safety and security of these royalty payments, and that's why capital flocks into these types of stocks. But if you look at the other industries, very bad performances, right? Like clean energy, a sector that has been performing relatively well. So it's still up 10%, 10.6% on the month, but last week it was down 10.3%. So a clear move towards risk off environment. A lot of stocks that we had seen earlier that were outperforming have just basically now given back the gains. So even regional banks, there was a big move towards people buying in anticipation of deregulation and so on. But if you look at it, on the month, it's down 4.3% roughly. Uh, Maybe there is some buying opportunity here, but it could move a lot lower, right? We also had a few more reports this week with auto lenders and, like, for instance, Credit Acceptance Corp, CACC. It was down massive after earnings. So you can look at the earnings yourself and figure out what's going on with delinquency and so on. Um, Capital One also reported, so the market has not really really done much there. Um, we can just quickly look at these charts, right? So this is Credit Acceptance Corp. Um, Massive moves, right, after earnings. And then we've got Capital One. So it reported on Tuesday. I mean, it's down, but right, post earnings, you can see, right, the market was very happy with the results. And now, if you look at the peak, we've moved from 230 to 207 and even below, right? So that was quite a big move. And the question to ask yourself is, in this new environment where we're getting job losses or job market is not growing, who is going to be overweight subprime risk? Subprime meaning people who don't have the best credit quality. And you can see a lot of funds are doing their work and they're basically de-risking and even going short a lot of these companies. Go ahead, Amin.
So are is also taking a double hit because the interest rates are expected to go down, so the margins might contract.
Are you talking about Capital One?
Yeah, so this financial,
Yeah.
institutions, lenders,
Yeah, I
banks.
mean,
Uh,
if interest rates are going to of kind of forecast to go down, it also means that the net interest margin will be, will be crushed from here. But I think that's not the real reason why, these companies are selling off. I think the market is kind of repricing the delinquency risks, right? I mean, if we actually start getting a poor job market, right? I think the last thing the market would be carrying here would be net interest margin, because if delinquencies rise, right, this is like a proper sucker punch. Because with delinquencies, what happens is you have capital impairment, which is a lot more drastic, right, in terms of the equity. It chips away at the equity value quite significantly. So if you look at these stocks, Capital One, Finance, even this one, right? Synchrony, Financial, right? You tend to see that the same kind of price action. So this one, it predominantly issues credit cards. And again, credit card is not the best of credit quality, right? So you're seeing delinquency risk being repriced by the market, or at least, you know, if you were long these companies, you're like, okay, I think now is a good time to take profits. There's one thing I wanted to show you. Okay, going back to Capital One. So Capital One also recently acquired Discover Financial Services. And by virtue of that, they acquired a big credit card book, right? If you were to look at their earnings, um, these guys are having to set aside significant reserves for the book that they've just onboarded. And the thing here is, if you're getting into an environment where delinquencies are going to rise, and you've picked up someone else's credit card portfolio that you haven't underwritten yourself, uh, there might be a lot of trouble as you start discovering that, they might not have been the best of clients, and the underwriting was not done to a strict or to the same kind of rigorous assessments that you would do with your own clients. Um, so there's a bit of risk with this company, and I think if you're looking for short ideas, definitely one to study. What's happening with our private equity brothers? Um, so they are basically now in between two camps, right? One is, if we go into an environment where interest rates will be lower, so this will be supportive of these companies, because now, a lot of these companies have a lot of debt, right? or the underlying holdings have a lot of debt. So lower interest rate would help them with refinancing at cheaper rates and so on. So it's stimulative to the asset value of these companies. However, if we go into an environment where rates are coming down and at the same time GDP is slowing down, then this spells disaster for these companies, right? So, for instance, like I think I've shared this in the Discord server. Every time the Fed has started a rate cut cycle, the G, there's been okay, not every time, but there's I think there are two exceptions to that if we go into past cycles. But most of the time, when the Fed starts cutting, is because a recession is coming, or we're already in a recession. So people who are, very happy that the Fed will be cutting and so on, might not realize that we're probably already in a recession, or we're at the start of a recession. And when the Fed cuts, you can go look at these charts yourself. A lot of times, the market is also gapping lower because the market realizes that demand is just not there. So cheaper in cheaper or lower interest rate make no difference because revenue is under attack, EPS is under attack, and a lot of these equities are just going down. So you can even look at we can look at this, maybe figure this out. So the Fed started cutting, if we look at, let's say, 2008, right? Or 2007, rather. It's a long time back. So this is 2020. Yeah, this is 2007. I think, when did the Fed start cutting interest rates in 2007? So they started cutting rates in September 2007, right? So this is where they started cutting, yeah? And you can see what happened to the market. So the Fed cutting could be the actual admission that the economy is in trouble, right? If we look at the 2000 cycle, uh, I think it's 2001, they started cutting. It says, okay, maybe if I do 2001 here. So they started cutting in, when was that? I think it was March, if I'm not mistaken. Let me just get this right. Okay, this is like, so they started cutting in April. No, it's 2000. Yeah, let's look at this. It's easier to look at a graph rather. So in 2001, okay, so yeah, they started cutting, let's say in December 2000, right? What happened here? So if we look at December, yeah, they started cutting somewhere here. And from there onwards, the market was not never up, right? It just went down. Of course, it doesn't go in a straight line. You still have bear rallies, right? Which are quite violent. Some of these are like 100% rallies or 50% rallies. Uh, but you can see, right? The Fed cutting does not mean that the market goes up more. So, of course, we're in a different environment now. We don't necessarily know how the market will perceive this. I think at the end of the day, it will just come down to the economy. We are seeing, strength in many segments of the economy. So the question is, the areas where we are seeing strength, are they going to start normalizing and, start coming down as well, which will then just, deal a proper blow to the economy? Or are we kind of at a normalization state where we've gone from an economy that was growing quite significantly to now normalizing to a more normal type growth? This is a question that I don't have the answer yet. But we'll figure it out over the next few months. As the data comes out, it will become quite obvious what's going on. It's always important to be prepared about this. So when the time comes, when the data is released, you understand exactly how to interpret it. In terms of factor analysis, what we can see is that the market moved towards large cap growth. So, the market is kind of seeking the security of large caps, and then all the other segments were negative. So whoever was playing the mid caps or small cap got crushed, at least on the week, right? And if you look at on a monthly basis, so the capital has basically just been moving towards large cap growth. So the market still likes growth, but it's kind of preferring to stay within the security of large caps. Is this going to change in the new environment we find ourselves? I think it's very unlikely. I think the market might even start rotating towards large cap value. And we could even see large caps selling off quite aggressively here. So keep an eye on these things. If you want to go buy a mid cap or small cap, of course, you should have these in your portfolio. All this is telling you is you have to do a bit of extra work to justify that the fundamentals are there to make sure that your long ideas would work. And also, what this is telling you is that probably the timing is not right for you to go and get like a couple of long small cap ideas in your portfolio. Even if you still want to get them in, what this is also telling you is probably that you should give that trade a bit more duration and not expect it to happen within the next 2-3 weeks. Is that clear? Hans, is that clear?
Yes, please.
So, this is how you interpret. This is basically the market telling you what's going to work and what's not going to work. Now it's for you to take that information and structure a portfolio that is not necessarily arguing with what the market is telling you, right? The most important thing here is to make sure that you are listening and interpreting the market signals accurately. We looked at commodities last week and we thought we probably were at the beginning of a bull market. I think that's been crushed with the price action this week. So as you know, Donald Trump flip-flop again on his copper tariffs. In studying what he was trying to implement at the end of the day, I asked myself, so what actually would be tariffed, right? If you apply whatever he's added to the regulations, then you're really at a loss to understand what actually gets tariffed. But anyway, the market moves on what this guy is going to do, and we obviously have to pay attention to that. Okay, so we're gonna move on to our segment now.